Well, folks, I hope you're ready. Every 3 months, the government requires anyone managing above $100 million to reveal their portfolio, to give transparency into what it looks like. And from that, we get to see what these investors hold in their current portfolio and what they've recently sold and what they've recently bought. We get an inside look into the best investors' portfolios in the world. These investors that manage this massive amount of money are called super investors. Now on the list today, we have the best of the best, starting off with Bill Ackman. He's made some recent trades with Chipotle, and he even introduced a new holding, which is a little bit of Nike. We'll be discussing why Bill Ackman is buying Nike. We also have Chris Hohn, the wide moat monopolistic compounding machine buyer. He manages $40 billion, and he's made some changes to his portfolio as well. We have Kantesaria, who I personally consider the best of the best. He follows a philosophy that's rigorous in buying high-quality companies, having an extremely concentrated portfolio, and once again, he proves that he is a long-term shareholder. We have Terry Smith. He's recently gone through a few troubles with his portfolio, so we'll see what's going on with him. We have Patrick Hargreaves from AKO Capital. AKO Capital is another one of these high-quality compounding firms, and I like to see the type of companies they own. They have a bit of overlap with the type of holdings that I buy. Then we have Chuck Akre, the living legend himself. He's not directly managing this portfolio, but we got to see what his team is doing. We have Josh Tarasoff. He's a small-time portfolio manager, only managing $350 million, but he's made a meaningful change into his portfolio, which is the introduction of Tesla, and he is the first super investor to ever buy Tesla. We have Pat Dorsey, the Morningstar moat rating investor. He's made some different changes to his portfolio. We, of course, have Warren Buffett. We're going to see the new positions that he bought into. And we have Nelson Peltz, the activist investor that recently sold some Disney, and he's also done an interesting trade with Starbucks. So we have a very full list to get to, where the goal is to give context and insight and understanding into what these investors are doing and what they're thinking. So let's first start off with Bill Ackman. He manages around $10 billion with Pershing Square Capital, and he's had around 17% returns. Let's go ahead and take a look at the portfolio and see some of the recent changes. We have the portfolio right here, and I instantly noticed some new positions. We have Nike and Brookfield Corp. Now, if we look at the recent quarter and we organize this by the biggest changes here, we can actually see that his single biggest change was selling a chunk of Chipotle. And this is something that does not surprise me at all. In fact, I was surprised how little he sold. He only sold 22% of the position, and that was around 5% of his portfolio. So Chipotle has done really well. It's raced up to a very high valuation. It's done really well for Bill Ackman, and now he's looking for opportunities to take gains in this company and to move on. And I think that's a good trade by Bill Ackman. He's held this company since around 2016. So this has been a massive winner in his portfolio. And now you see him trimming the position. I believe this is going to continue. As long as Chipotle trades at a high valuation, Bill Ackman will be reducing his position. I sold completely out of Chipotle a month ago. So I like the trade here. I think that's a good trade by Bill Ackman. No problems there. Now, the other trade he did here last quarter, which is more confusing to me, is one that I don't necessarily agree with. He also trimmed a good amount of his Google position. He trimmed 20% of it, or 3.22% of his portfolio. If we look at Google here, it's trading at a 21 forward PE ratio. The company is up okay this year. It's up 16%, but it's nothing out of the ordinary. Google's a great company and it's growing its free cash flow per share. There's an argument to be made that maybe he's trimming because the DOJ might break up Google, but most analysts believe that Google's worth more separate than it is together. In fact, when you do a sum of the parts and you break down all the revenue lines of Google as if they were individual businesses, it would almost certainly trade at a higher valuation broken up than it does together. In fact, when you have companies like this that are conglomerates where they're grouped together, that gets a bit of a discount. So I don't like the trade here with reducing his Google position. I think Google's in great shape with a great valuation and a great future. I think the Department of Justice is likely not to break up Google, but even in the event they do, it's probably worth more broken up. Now, when we move on to the next biggest trades, they're both buys. The first one being Brookfield Corp. And I know that this one's going to make a group of investors very happy that love Brookfield and Brookfield Asset Management. They love Bruce Flatt, the CEO of this company. He's a great public speaker. He's a great communicator. He's also just a great asset manager. He's built this into an incredible business. He tries to deploy money into different opportunities that have high returns. And Brookfield specifically focuses on infrastructure projects that governments can't afford because governments are too over-leveraged. So they go to private companies like Brookfield to help invest in core infrastructure. Now, Brookfield Corporation can be viewed as an alternative asset manager. In many ways, it's similar to investing with Warren Buffett, where you have this key guy that can deploy capital into whatever he wants to buy. But in this case, instead of Warren Buffett, it's Bruce Flatt. And Bruce Flatt, he accepts a lot of projects and deploys a lot of capital wherever he believes that they can get reliable, predictable, attractive returns. So you see this type of relationship here and structure where they invest in just about anything that they can get good returns on. Whether it's real estate investment trust, whether it's renewable power, infrastructure, venture capital, private equity, public companies, on and on and on. They invest in anything where they believe they can get an attractive return. And this purchase doesn't surprise me from Bill Ackman, because Bill Ackman likes these type of alternative asset plays. He does them all the time. In fact, if we look at his portfolio, one of Bill Ackman's top positions is the Howard Hughes Holding Corporation, which is like a real estate corporation, an alternative asset, somewhat similar to Brookfield. So I see this company as a natural fit into his portfolio. He's investing in someone that he trusts, which is Bruce Flatt and the Brookfield Corporation name, and I think there's a good chance he'll do decent with this one. So this position to the portfolio fits in nicely with the rest of Pershing Square Capital. It's a high-quality company with great management. It has a high amount of predictable cash flow, and it trades at a reasonable valuation. Now, it is a very small position, only 2.7%, so this is like a quarter position for Bill Ackman. Maybe he's going to buy more and he'll continue buying into this one, but so far it's a small, low-risk position. Now, the one that I find even more interesting and exciting is Nike. Bill Ackman purchased new into Nike with a small 2.2% position. So again, this is a very small position. It's like a quarter position for Bill Ackman. Now, the first thing I have to mention here is Nike is not a new company to Bill Ackman. In fact, he's invested in Nike before. He's put around $200 to $300 million into Nike. He built it into a sizable position. It traded up $100 million, and then he sold, and he ran away with the gains. So he made a nice return in a short amount of time. He got out with his gains, and Nike overall was just a win. It was a win in his portfolio. So seeing him go back to Nike now is interesting. The one thing that I'm interested to know about Bill Ackman's Nike position is when he purchased it. Because if we look at how Nike's traded over the past 3 months, it just recently went through an enormous drop from $94 to $75. The majority of the quarter, which this Q2 reports, is before this drop. There's a good chance that Bill Ackman had very unfortunate timing here, that he bought a company right before it dropped big. Now, there are a couple days at the end of the quarter where he could have bought right after the drop, in which case that would have been much better timing. So we don't know exactly when Bill Ackman purchased it. Did he purchase it before the drop or after? Now, we'll find out eventually whether or not he bought it before the dip or after the dip. Hopefully he bought it after the dip, because that will make this a much better position. But either way, I have two predictions of what Bill Ackman's going to do with his Nike position. Prediction one is you will see him selling it within 2 years. I think you're going to see sales of Nike within 2 years, no matter what direction the company goes. I don't believe that this is a long-term position, because long-term positions for Bill Ackman require great amounts of growth, great amounts of future revenue and free cash flow per share growth. It is true that Nike's growing, but it's not the fastest growing company. It's far more mature than the majority of companies he holds. The revenue is only growing like 4 or 5% per year when inflation is 3%. So this is a slow grower at this point. It's a company that's recently traded down, so it's a good value play, but value plays are temporary. Growth plays are for the long term. So I see Bill Ackman selling Nike within 2 years. The next prediction is that Bill Ackman will sell Nike if it trades up above 20% from his buy-in price. I think if he gets 20% or above gains, you're going to start seeing sales come through. So those are my two predictions. He'll be selling the stock within 2 years, and he will sell it if he gets above 20% gains. If I had one criticism for Bill Ackman's portfolio and his recent trades, the biggest criticism I have is reducing Google to buy Nike. I think that's a questionable trade. When I pit Google against Nike, Google has faster growth and arguably a much wider moat, and Google's trading at a cheaper valuation. The valuation of Nike in the forward PE ratio is 25. The valuation of Google right now as a forward PE ratio is currently 21. So Google's at a cheaper valuation, it has faster growth and a wider moat. So I understand the trade here. Google's gone up as Nike's recently dipped. But as far as I'm concerned, Google remains a much better investment than Nike. Next up, we have a big one. This is a huge super investor managing $40 billion, so 4 times what Bill Ackman manages. And this is Chris Hohn with TCI Fund Management. The reason that he has so much money to manage is because he's compounded the wealth so quickly. He's grown it so fast, 19% returns over the past decade. And investors want to give him the money because he's doing so well over the past 5 years. Chris Hohn has really been an exemplary investor. It's really been incredible. When we look at his portfolio, we can instantly see some recent trades here. One of them is that he bought a brand new company, and we'll be looking over that one. But if we organize this by the most recent quarter and the biggest trades he did, the biggest trade he did was he sold Thermo Fisher Scientific. So he's out of that company. That was a high quality, very wide moat, monopolistic company. He's out of it. And instead, he bought in to Google. And this is what I think is the right direction to go. I don't agree with Bill Ackman selling Google. I like Chris Hohn buying into it. I still think Google's a buy right now. So I really like to see him increasing his position into Google. I think that's a good move. We also see a new holding here. The ticker symbol is FER. Ferrovial, together with its subsidiaries, engages in design, construction, financing, operation, and maintenance of transport infrastructure and urban services internationally. So this new addition to the portfolio is a company that specializes in transportation and infrastructure maintenance. It's a very interesting position, but it also fits along with other companies he holds. If we look at his portfolio overall, his top position is still GE. That's one that I would never add to my portfolio. I don't understand GE enough. It's a company that doesn't seem like a great investment to me, but this has been a massive winner for his portfolio. He's already doubled his returns in his largest position, and GE remains 18% of his portfolio, almost 19%, and he even added to it last quarter. He also added more to Moody's Corp, which I like seeing because this is one of my largest positions in my portfolio. He added 9% to the position. He still holds Microsoft as his 3rd largest position. No disagreement there. It's one of the best companies in the world and it remains a staple of any great compounding portfolio. We have Canadian National Railway. When I go to the financial category of my portfolio, I have many of these same companies right here. And you'll notice that all of them do well. All of these companies just perform so great because when you examine the qualities of them and the metrics, there's not many better companies. So whenever I'm trying to invest in a new company and I'm doing analysis, I always ask, is it better than what I currently own? And 99% of the time, the answer is no. They're typically not better than these companies. So when we look at Chris Hohn's portfolio, the reason that you see very few changes is because what he already owns is so good. There's no reason to change to something that's worse. So overall, what I see here is a continuation of this theme of Chris Hohn focusing on quality, focusing on wide moats, monopolistic businesses, high margins, efficient capital deployment, very fast free cash flow per share growth. And he doesn't deviate from the strategy. I don't see him adding in really low quality companies. So I have to imagine, even though this new one's a very small position, it's probably a very niche and required company that has an incredibly wide moat. That would be my guess. I like Chris Hohn's portfolio. I like the trades that he's done. I like that he's adding more to Moody's, S&P Global, and Google. I think those buys will do really well for him. Now, next up, we have Dev Kantesaria from Valley Forge Capital Management, who is my personal favorite. Out of the whole list, I feel like he resembles my investing philosophy the most. He's a high-quality compounding investor that only focuses on the best companies. And I think he takes this to a level that is slightly better than even what Bill Ackman does, and even maybe what Chris Hohn does. There's other great investors following this methodology, but I've never seen someone execute it with such concentration and such success as Valley Forge Capital Management. It really is incredible. His track record is one This is just astonishing. In fact, if we zoom out a bit and we look at his activity here and we examine the type of trades he's done, you can see the start of tracking the portfolio in 2019. And if we look at the colors of his trades, the buys are in green and the sells are in red. So anytime he sells a position, you'll see it highlighted in red. Notice how you don't see any in 2019 or 2020, just quarter after quarter of buys and buys and buys. He's not selling anything because he rarely makes a mistake. He rarely sells a position because the companies he buys are so good that he rarely ever has to sell. We go all the way from 2020 into 2021 and we get into Q1 of 2021, and that's finally when he starts to sell positions. He sells out of Aspen Technology after it races up into the moon. So this was a great sell on his behalf. And then we get into Q4 of 2021, where everything is into bubble territory, and that's finally where he starts to trim his positions a little, when everything is super expensive at all-time highs into bubble territory. 2021 was a significant bubble, and that's the only time that he sells. Now, he doesn't sell a lot even then. He still holds on to his positions, and since then he's done some position changes because he sold out of Amazon to buy Intuit, and Intuit has been an incredible performer. So even though he sold Amazon at a bad time, he bought a great company at a good time. When I review the trading of super investors, he has the best track record of any of them. He rarely loses money on any position he goes into, and most positions he goes into, he makes significant gains. Now, when we look at his portfolio, the only trade he did last quarter, once again, was basically nothing. He reduced his FICO position by 0.34%. And my guess is he didn't want to reduce it at all. I think he sold a little bit to pay for some expenses or fees or maintenance to run his firm. I don't think this is a real sell. You don't rebalance your portfolio by selling 0.34%. And FICO remains a 33.78% weighting in his portfolio. So it's over 30%. A lot of people are concerned about concentration, but he's managing $3.8 billion and over $1.3 billion of that is in one position alone. In fact, out of his 8 positions, the majority of them are right here in these top 6. That is 90% of his money in these 6 positions. We have FICO, S&P Global, MasterCard, Moody's, Intuit, and Visa. I own 4 of these 5 companies. I love S&P Global, I love MasterCard, I love Moody's, I love Intuit. I also love Visa, but I went with MasterCard as well. And then I also missed out on FICO. This is one of my bigger regrets. I did research on the company, I listened to the thesis, I agreed with it, but I thought the valuation was a little too high. It was trading at like a 40 PE ratio, and since that time period where I initially did that research, at around $700 per share, FICO has raced up substantially since then. If we look at the stock price now, it's added on $1,000+. It is now $1,700. It's easy to judge these decisions in hindsight, but we have to maintain a disciplined approach. The fact that he's still holding FICO today is impressive in and of itself, and it shows the discipline he has when investing in these companies. Almost every investor holding this company would want to sell out of it by now. It's up 57% year to date. Over the past year, it's up 109%. Over the past 5 years, it's up 407%. It's raced up exponentially since 2022. So this is a company that's raced up dramatically. The PE ratio is above a 50 forward PE. The free cash flow yields below 1%, and he's still holding. He's still holding it as 33% of his portfolio. A massive concentrated portfolio, the majority of it in this position, and he won't sell. This is diamond hands. This is someone that's confident in his picks. The reason that he won't sell FICO is because he has continued confidence in its free cash flow per share growth. FICO grows by raising prices. They can raise prices because of the value proposition and the dynamics of the industry. They have a monopolistic segment of credit ratings, and they have extreme control over pricing. When FICO pushes through a price increase, customers pay for it without really even knowing. When you're buying a home and you're paying for a home mortgage, you don't really care whether or not your credit rating was $1 or $2. So this little score, which is a tiny part of the total thing you're purchasing, is not something that consumers are paying attention to. When we look at the free cash flow per share of this company, it's now to a record high of $22 over the trailing 12 months. And you can see the growth is just phenomenal, growing 27% free cash flow per share growth over the past 5 years. He's everything that great investors talk about being, focusing on the long term, having concentrated positions, not diversifying your portfolio with a ton of subpar holdings, doing deep dive research, extensive knowledge into your positions. So he's reaping the rewards of his highly polished investing philosophy, and one that I've tried to emulate to some degree. So again, I think that Dev Kantesaria is doing the right thing. He continues to execute on his strategy. He's outperformed the market by a huge extent, and he's done so with a handful of companies. The only criticism that I could give, or feedback that I would give about Dev Kantesaria's portfolio, is it does have a very high overlapping of risk factors. For example, Fair Isaac is a credit rating business. It's a credit rating business for individuals. S&P Global is a data and credit business. MasterCard and Visa are credit card businesses, reliant on people's credit. Moody's is a credit rating business. But when we look at this, MasterCard and Visa have very similar overlapping risk factors. S&P Global and Moody's likewise have very similar overlapping risk factors. So he really only has 2 to 3 different unique companies in this portfolio. So it's very, very concentrated. It's even more concentrated than it looks at first glance because of how similar MasterCard and Visa and Moody's and S&P Global really are. So that's my only criticism. It's highly concentrated, overlapping risk factors, but the risks have not played out, and this has been a massive winner so far. Now, next up, we have Terry Smith of Fundsmith, investing with $25 billion. He's had a pretty good track record so far, but in the most recent years, he's made a couple core mistakes, specifically with selling. He sold a lot of companies at the wrong time. But overall, Terry Smith is a great investor. He has a basket of high quality stocks. Let's go ahead and take a look at some of his most recent trades. Here we see his biggest trades, and I'll just point out that none of these are big trades. These are all tiny trades. The largest one is 0.87% of his portfolio. So none of these are all that meaningful. These are tiny little rebalances, tiny fractional changes to the portfolio. The only thing that he really did last quarter was he added Texas Instruments and Fortinet. But even so, if we look at his holdings, Fortinet is holding number like 15 or 16 at a 2.53% position. So this is a very small holding overall in the portfolio. When we look at the Terry Smith portfolio, there's a lot of reductions across the board, and he's reducing all of these companies somewhat equally. That just means that some people have pulled their money out of the fund because he has a lot of investors. When one of the big investors wants to take out some money and he has some redemptions, he has to raise capital, which means he just sells across the board. This isn't intentional trading. It's him reducing these positions for redemptions. Now, looking at his portfolio, there's really not a lot of changes here. He still invests in a lot of high quality companies. He filters them by margin and return on capital employed. He looks for companies that sell things that are subscription based or small purchases. His top 2 positions are Microsoft and Meta, which I think are both great. And other than that, there's not really any meaningful changes. I think the fact that Terry Smith has made a few key mistakes over the past couple of years has given him a little bit of pause. I think he's going to be a bit more careful about his sell criteria, because the sales that he did over the past couple of years really hurt his performance. So I like seeing that he's just holding on. He's not making any dramatic changes. Now, next we'll be looking at the portfolio of Patrick Hargreaves from AKO Capital. This is another high quality compounding portfolio. They manage $7.2 billion. And if we look at the portfolio overall, you see a lot of familiar names here. The same type of companies continually show up across these investors because they share this same type of overarching investing philosophy. You see Alcone at the top, then Microsoft, Fair Isaac, GE. That's a shared holding with Chris Hohn. You have Intuit, which he shares with Dev Kantesaria. Then you have Accenture. You see an exchange in this one, and then we see Visa, another super common holding amongst these super investors. And then we also see some that have shown up a bit more unique in my portfolio, one of them being Booking Holdings. I bought in new to this one over the past month. I'm about even on it now, just level on the holding, but I'm excited about this one, and I like seeing it in the portfolio of AKO Capital. We also have Moody's Corp. We have Thermo Fisher Scientific, Ferrari, Waters Corp, and more of these high quality companies. The top trade he did was add 3% to Accenture. Accenture is a consulting firm that has fantastic fundamentals, growing revenues, free cash flow, net income, earning per share. It has a lot of cash on hand, no long-term debt, and the stock is in a dip this year, down 6%. So it seems like it could be a good buy. The reason that I don't personally invest in this one is I simply don't understand the business enough. It's a consulting firm. I don't know really what they do, what their business strategy is, or what their moat really is. So my ignorance of this position is the reason that I don't go into it. I just avoid it completely. The other company that he added to, 2.5%, is Amazon. And this is a new position to the portfolio. Now, obviously, I'm very bullish on Amazon. Based on the analysis I've done, I think Amazon could still see around 20% gains over the next year. So I think there's significant upside in the next year. It depends on how Amazon executes. So we'll see, but overall, this is an addition that I like to see in the portfolio. Another interesting thing I see here is, unlike Bill Ackman, who just recently bought into Nike, AKO Capital recently just sold out of Nike. Now, they could have sold and bought at different points. If AKO Capital sold this before the drop and Bill Ackman bought it after the drop, then this tells two different stories. So maybe they're selling and buying at different points, but they could also have been buying and selling at the exact same time. And personally, again, right now, I think Nike's an okay position. I think it's fine, but I like Amazon and Google a little bit more. Another interesting thing he did, and I think this is really interesting, he added to his Fair Isaac position. He bought 27% more of FICO, adding 1.4% to the portfolio. If we look at FICO's chart this year, they bought it somewhere within this time period. And no matter when they added the position, they're already in the green. So this has been a fantastic addition to the portfolio. Even if they bought it a little bit high, right at the peak, it's still higher than where they bought it. So another great addition to the portfolio. A lot of these type of portfolios get criticisms because of the valuation that these stocks trade at. But if you look at just the simple PE ratio, that leaves out the majority of context of their overall valuation. Anytime you're running valuations on companies like FICO or Microsoft or Intuit, you can't just look at forward PE ratios. You also have to take into account the margins of the company, the return on capital employed, the runway for growth, the revenue trajectory of the company. When you factor in more holistically all the valuations, all the ratios, all the profitability metrics of the company, the PE ratio makes a lot more sense. The reason that these companies trade at a higher PE ratio is because they're much higher quality companies than the average of the market. And the likelihood of these companies being successful is much more predictable. Now, finally, we move on to Chuck Akre with Akre Capital Management. There is a huge caveat looking at this portfolio. While the portfolio still bears his name, it still has Chuck Akre on the label, Akre himself is not managing this portfolio. He's retired. The guy's already super rich. He's done his job. He's proven himself. He's one of the best investors alive. So he stepped back after training his lieutenants and different employees to run the portfolio. And this is where I have difficulty looking at what's going on with this portfolio. It's really difficult for me to see. A lot of the magic of Chuck Akre and his investing philosophy of buying high quality companies and holding them long term seems to be vanishing before our eyes. Look at what they're doing to this beautiful portfolio. They're selling their MasterCard position. And it's not too big, it's a 16% position, but what's wrong with MasterCard? Most other high quality company investors are buying into this position. MasterCard is doing great. They're growing in the amount of cards, every KPI is going up. If you look at the fundamentals of MasterCard, at just a quick glance, we have some KPIs here with Qualtrim, and look at the total MasterCards worldwide. It is a lockstep trajectory up and up and up. There's nothing wrong with this company. The revenue by segment's growing, the value add services is growing, the regulation environment seems to be the exact same. When we look at it on a trailing 12-month basis, you can look at the free cash flow over time, and it is one of the most predictable, reliable companies in the market. The free cash flow per share is growing even faster. And then we see the same thing with Moody's, one of their best investments ever, and they're selling out of it. Chris Hohn is adding to these positions. Chuck Akre's employees are selling out of it. Now, we have some other trades going on here. They've added a couple new companies. CoStar Group is one of them. They've added 20% to that position. And they added a brand new position. This one is Airbnb. And this is something where I actually like this SPY. I like seeing them buy into Airbnb. And I see a lot of resemblance of Airbnb to MasterCard. Both of them grow organically. Both of them are worldwide businesses. Both of them have great fundamentals, great free cash flow growth. Both of them are high margin businesses with ample runway of growth. And both of them face a regulatory environment that's very harsh. Airbnb and MasterCard both face a lot of regulations. So I see this as similar to MasterCard in a different sort of way, but I don't think it's quite as good as MasterCard. And I don't like the trade of trading out of MasterCard to buy Airbnb. When I look at Chuck Akre's portfolio now, it is very clear that he has stepped away from running this one because the diamond hands are gone. Many of the best, highest quality companies are being sold for slightly inferior companies. And I'm afraid that what's going on with this portfolio is a classic example of new management coming in. They have to justify their presence by making trades that aren't necessarily the best trades. And I don't think these are good trades. If I was running this portfolio, I would hold on to Moody's and MasterCard. I would not be trading these companies for inferior ones. Now, next up, we have a super investor that takes a different approach. This isn't a high quality compounding portfolio. This one's more around tech companies and exciting companies. We have Josh Tarasoff of Green Lane Capital. He manages a smaller amount of money. So he's not quite as known. He manages, in fact, a much smaller amount of money, which is $360 million. Now, when we look at his portfolio, it looks relatively the same as last quarter, but with one very notable change. And that is right here, a brand new position to the portfolio, which is a 6% position in Tesla. And this gives Josh Tarasoff the award. He's the first one in the super investor category to ever own Tesla. The very first one, and he's the only super investor that currently owns Tesla. Now, when we look at the portfolio holistically, we have some good holdings in here. I like the concentration into Amazon as a 25% position. I don't mind Brookfield Corp. I think that's another good one. Berkshire Hathaway is a very safe, conservative investment. And then we get into ones that are a little bit more iffy. We have Trupanion, and we have Burford Capital. In his recent trades, he sold Shopify and Monday.com. These were two positions that I was never that excited about. I think Amazon's much better than Shopify, and Monday.com, from my analysis, had no moat. It is a company without a moat. So I think overall, he exited out of two iffy positions, but I think, unfortunately, he introduced another iffy position, and that is Tesla. I know that Tesla has a lot of bulls, a lot of fans of Elon Musk and the entire story of Tesla, and I don't discount that. I think Tesla is an amazing business, an amazing story. I like Elon Musk. I think he's very unique. I'm glad that he owns Twitter and it's a free speech place. I like a lot of the stuff he's doing, but looking at this from an investment perspective, I have concerns about Tesla. The first concern about Tesla is that it trades at an 88.5 PE ratio. It's a very expensive valuation. That's more expensive than FICO or MasterCard or Moody's or any of these companies. Tesla is at a $640 billion market cap, and the company's currently generating, in the past 12 months, only $1.72 billion of free cash flow. To put that in perspective, last year, Netflix generated $7 billion in free cash flow, and Netflix trades at half the market cap of Tesla. So this company's very expensive today. Based on the current multiples, the current price, it's extremely expensive. Even if the free cash flow goes back to where it was in 2022, even if we get back to these all-time high free cash flows, it's still more expensive today than Netflix. That's the price this company trades at. And with Tesla, you're relying on a story, a narrative playing out where they create full self-driving, where they create a massive robo-taxi network. And that robo-taxi network generates enormous amounts of free cash flow. So investors are relying on this narrative to play out that I think is difficult for it to work out correctly. And much of that narrative is already priced in. And I'm afraid that Tesla may do what it's done over the past 4 years, where it kind of flounders around, up and down, around this valuation range. Maybe you can get a good trade out of it, but unless things change with the cash flow, unless the company truly generates growing amounts of free cash flow per share, the valuation will prevent this company from growing in stock price. So we'll see how this holding does. Maybe he'll get a good timing on the stock going up from $200 to $250, and he can make a good trade there. Tesla does that all the time. But either way, this isn't my favorite trade I see in these super investors' portfolios. Now moving on, next we get to Pat Dorsey, the Morningstar Moat investor. He came up with that rating, and now he manages his own fund called Dorsey Asset Management. He manages currently around $800 million, and I've been critical of some of the trades he's made in the past. I thought that they were very poor trades, but he somewhat redeemed himself, mostly with Meta. He went heavy into Meta during the lows, which dramatically benefited his portfolio. So I like some of the recent trades that Pat Dorsey has been doing. Now, if we look at his most recent trades of last quarter, we organize them by the biggest trades, we have a reduction in Google. So this is a disputed stock. Some investors are buying into it, some are selling out of it. This time he reduced the position by 45%, and with that reduction, with that raised capital, he purchased Sprout Social and AutoZone. When I look at Sprout Social, this is a much smaller company, it's unprofitable, and it's recently down 43% year to date. And this is why he bought the company. He saw this enormous drop in the company, he saw weakness in the stock, and then pounced on it as an opportunity. So he's now transitioning from investing into highly profitable, scaled companies like Google to smaller, unprofitable companies like Sprout Social. This has higher risk, but also higher reward. He may get a bigger bounce in Sprout Social than Google. The other company he added to was AutoZone, which I think is fine. Let's take a look at the share count over time from AutoZone. Look at this chart here. It continually goes down. If we zoom into the past 10 years, you see the trajectory. It's not changing. Last year, the share count declined by 6.4%. And this is the reason you buy AutoZone. It's the only reason you buy AutoZone. It's the only thesis in the company that they're going to make free cash flow. They're going to buy back shares. That's the thing AutoZone does. They do it well. They stay focused on it. And it's led to really good market-beating returns. When I look at Pat Dorsey's portfolio overall, it's not my favorite. There's a lot of companies here I think are questionable, Smartsheet being one of them, Wix being another one. I think that Wix has a very weak moat. We have Upworks and SEMrush. These aren't my favorite companies. So overall, I like some of the holdings here, but I think it's one of the weaker portfolios. And personally, I would not give my money to Pat Dorsey to manage. Now, next up, we have the man himself, Warren Buffett, the living legend. Let's go ahead and jump in. We already discussed in depth the reduction in Apple. So if you want me to cover that, just go over and view one of my previous videos on the subject. It requires an entire discussion in and of itself. Now, the position that he added to that I think a lot of investors are going to be excited about is this one right here. It's a very small position in the grand scheme of things. In fact, it's a 0.1% position. So it's tiny. It's a tiny fraction of Berkshire's portfolio, but in and of itself, it's still a large position for most people because of how big Berkshire is. So he bought hundreds of millions of dollars of Ulta Beauty. That has to make a lot of investors excited today. Now, I've already gone over Ulta to some extent. I think it's at a great valuation. I think it's a great company. My concern for any type of holding like this is, of course, increased competition. There is a lot of reports that Sephora is really aggressive with their expansion. Sephora is expanding in total locations. So if you're doing research on Ulta Beauty, make sure you're also doing research on Sephora, which is one of their primary competitors. If Sephora gains too much market share, it does put pressure on pricing power of Ulta Beauty. Another company that I believe is competing to some degree with Ulta is Amazon. There's reports from Piper Sandler that more and more teenagers are buying beauty products from Amazon. Now, overall, even with those concerns of increased competition, I don't hate this buy. I think this is one of the better buys that Buffett has done recently. And it's not the case where I just like everything Buffett buys. Some people may say, Joseph, you just love Warren Buffett, so you agree with everything he does. That's not true. I was highly critical of Warren Buffett buying Paramount. I said repeatedly that I don't understand why he bought it. I said repeatedly that Paramount Global is a value trap and I wish he would sell it. And he eventually did, to a huge loss. That's one of the things he sold this quarter. So I have been critical of different purchases that Buffett has made within his portfolio. I think this is a decent one. It's not my favorite purchase. There's other companies that I'd be buying instead, but I think this overall fits well within the value investing theme of Warren Buffett. It has a very low PE ratio, a high free cash flow yield. It has some network effects and it has some moat, and I think the company will grow in value. Now again, when we put this into context, this is a 0.1% position. So 1/10 of 1%. I would not take from this that Buffett loves Ulta Beauty so much, I should make it half of my portfolio, because he's certainly not making it half of his portfolio. It is a very small position. But overall, looking at the most recent quarter, the most meaningful thing that Berkshire did was sell half their Apple position. Now finally, we move on to Nelson Peltz. This is an activist investor, which means that he tries to promote change in companies where he sees there's problems in management or different value to be had. Now he manages around $4 billion. It's mostly his own money, but he also runs a fund called Trion Fund Management. When we look at his portfolio, we have his current positions here, which I'll talk about, but one of the ones that I think is worth mentioning doesn't show up anywhere in Dataroma or on his recent trades or on his 13F, because he entered into the position and sold it all within the same quarter. And this was what I consider to be a bit of a sneaky trade. I think this one's a bit more sneaky than most trades. Apparently, Nelson Peltz had secretly been buying in a stake in Starbucks. So he's buying in a very large stake in Starbucks over the past 3 months. And he was talking to the board, he was talking to management, he was talking to the executives. And then when Starbucks had that 20% pop on news that they had a new CEO, that Brian Niccol from Chipotle was coming on as a CEO, he sold. And this is the part that I think is a bit sneaky. Treon had conversations with the Starbucks board chair, Melody Hubson. So there's official reports that Nelson Peltz knew and was talking to the board of Starbucks. But there's a lot of unanswered questions. Did he know that Starbucks was working on replacing the CEO with a legendary CEO? Was that advanced knowledge that only Treon partners knew because they were in conversations with executives and board members? Because if he knew that they were in the process of swapping out the CEO, that seems an awful lot like he had knowledge that wasn't public knowledge. And the fact that he sold immediately following this change in CEO seems very beneficial for Treon partners and Nelson Peltz. Now, we don't know what he knew. We don't know what the board told him. We don't know if it was a surprise to him like anyone else and he just took the gains. So I'm not suggesting anything other than this seems a little bit sneaky and maybe it should be looked at a little bit. Maybe they should find out what he knew and when, because this is awfully convenient timing by Treon partners, who was in talks with the board. Now, if we look past that and look at his current trades that are more public, that are viewed this quarter, the biggest change to his portfolio is he reduced his Disney position by 72%. He was an activist investor in Disney. He sold the company after the price went up. He also bought into Solventium Corp. He bought into U-Haul Holdings. Those are two interesting companies he's buying. And he's reducing his position in Invesco and Ferguson. Nelson Peltz is not an investor that's a long-term compounding investor. He's an activist investor that holds cash, enters into companies, tries to incur change, and when he gets a bump in the stock, he runs. So it's someone that's more difficult to follow, but I do like some of the changes he's made to companies. But overall, Nelson is not someone that I would model my portfolio after. Now that's all for this time. If you like this type of content, you want to see more of it, make sure you subscribe to the channel with the notification icon on. And if you want to see more exclusive episodes, you can do so by checking out the Patreon. The Patreon membership includes a Discord community that I'm on every day, exclusive episodes every week. We just had an hour-long one yesterday, as well as full access to Qualtrim.com. You can try it out for free with a free trial. That's all for now. See you in the next one.